why I'd much rather go with a trend late than fade a trend early. And we'll go to the charts to look at the E-mini NASDAQ 100 futures. Let me take you to this week's NinjaTrader Charting Edge. Pulled up the micro E-mini NASDAQ futures here on a daily chart. You know, you could also look at this on the NASDAQ, the NQ E-mini NASDAQ 100 charts. I'm pulling up the micros because they keep growing in volume, and more traders I know that were trading NASDAQ are going to the micros because it's so volatile. And I want to start off by showing you something that a lot of traders talk about, and it's really probably the most talked about indicator, I would say, that any trader will ever talk about, and that is the 200-day moving average. Same old with the Bollinger Bands, 20-period, 3 standard deviation Bollinger Bands. That gold line is that middle Bollinger Band, which is just a 20-period moving average. The red is the 200-day moving average, and been seeing a lot of talk about it lately on Twitter, on FinTwit, and you can see that we've now tested it multiple times in a row here this year and really have failed at it each and every time. Only a couple of closes above it. One thing I will say when I look at moving averages is never be in too much of a hurry on one daily close, no matter what moving average you're looking at. I think especially for the 200-day, if you're trading that time period, I like to see multiple daily closes, at least 2 or 3. So far this year, we've only had, I think, 3, and they were scattered. They've not been consecutive. And something that I noticed when I was looking at my big picture weekly and daily charts, when I looked at this 200-day moving average, was something very interesting. As you can see, we've come off quite a bit, and today as we're recording, the NASDAQ is down quite a bit, coming off of that 200-day moving average. I want to show you a sequence of things I've noticed using the 200-day moving average maybe a little differently than you've seen in the past. Let me take you to my next chart. Okay, so something that I'm looking at when I look at moving averages, or really anything for that matter, but I think really specifically for the 200-day moving average, because it's so widely used and talked about, is I like to see if I could find something really beyond just looking at daily closes above or below it. So what I did was this. I went back to the last time we tested the 200-day moving average way back in October of last year, and I wanted to see how many days it took from the time we tested it to making a high. And it was 34 bars, it took 49 days, and the total points that we moved from the low to the high was roughly around 2,200 points. Now, from there, we went sideways for quite a bit of time and then retested it here. But now this time we got below the 200-day moving average. So what I did was I wanted to see how long it took to make a low and how far away from the 200-day moving average did we get. And look at this. It took 36 bars, 53 days, which is very close to the time it took here to make from the 200-day to make a high. Now crossing below the 200-day to make a low. And it was roughly 2,000 points, 1,945 it says on here. And to me, that's really interesting because it took about the same sequence of time and about the same distance to make a low. So when I look at this low now, compared to what it did on this high, I really kind of like this low. What does that tell me going forward? Let me take you to my next chart. So what I did here was I took the time from when we made the high to when we went back and retested the 200-day moving average. How much time was spent after the time was made before we got below the 200-day, which in this case would potentially be back above it. So if you look here, it was 39 bars, roughly 58 days, and we had a trading range of roughly 1,800 points. Let me take you to my next chart. So if we take that same time frame, putting everything in context here, how long before we would spend some time below the 200-day and then get back above it? Well, if you go back of what that last chart said, we'd have roughly an 1,800 point range, which would put us right around 13,500 if we were to get a significant pullback in the NASDAQ. And it'd be around 50-something days, which is what that was on the previous slide. And that would take us to somewhat middle of May, maybe even possibly early June. So the point of me looking at all of this is to see, is history going to repeat itself? Like I showed you through each one of these slides, we are spending a certain amount of time above or below a 200-day moving average, a certain amount of time testing it, really testing it like we did here. Now we're potentially going to be testing it here. So if history repeats itself here like it did back here after making that high, which I think actually very well may be what happens here, Not only because the possibility of history repeating itself, but as we're recording today, the NASDAQ is coming off a significant amount off of this 200-day moving average. And these top of these Bollinger Bands and bottom of these Bollinger Bands are probably going to start to come in. And you know how I like that trade. I think we're going to be boxed off. And I think coming back to that 20-day moving average and just trading sideways, potentially in an 1,800-point range until May could be the case. The reason why I even like to look at stuff like this is because I like to see primary trend. What is the primary direction of the market? And when I look at it right now, it's very difficult to say. I think we are actually going to be in a two-way trade. It's not always about being really bullish or being really bearish. A lot of times it's just identifying through your homework. Maybe we're range bound. Maybe we're just going to have a lot of sideways action going forward. So to me, I think it's important as traders to go beyond just looking at what happens at a 200-day moving average. Look what happens before it. Look what happens after it. And for me, right now, my view is I think the NASDAQ could be in for a really volatile sideways range for a period of time. Final thing, what changes my mind? Because that is always the number one thing I want to talk about is what would change my mind? A violation of this recent high or a violation of this recent low. If that changes, then the whole sequence is off. But if we stay within this area that I boxed out, I think we're looking at two-way trade for the E-mini NASDAQ. Micro copper futures are coming to CME Group. The new symbol will be MHG. They'll be 1/10 the size of the larger copper contract symbol HG. To learn more, go to cmegroup.com. So last week I talked about how I got beat up a little bit giving back some of the money I had made in crude oil by getting a little aggressive in a trade. So I am coming off of a drawdown. I even talked on social media how I took a couple of days off just to regroup, refresh the body and the mind. And I put this tweet out the other day. When coming off of a drawdown, my number one focus is to wait for my favorite setup. I think it's extremely important to have a favorite setup you lean on after a big loss. I like to build my confidence back by trading it small and just accept the result. Get back into the flow in a good rhythm. The most important part of your trading is confidence. When you give back some money, and we all do it, you have to get back, in my opinion, to your favorite setup, your favorite look. If you don't have a favorite look or a favorite setup, I think it's really important to have that because when times get a little tough or maybe you get just out of sorts and you make a couple of bad decisions and you lose some money and maybe your confidence is shaken a little bit, you need something to lean on. Too many traders don't have that favorite setup. They just have all these different setups and they really don't rank them. I think it's very important to rank it. What setup is my favorite? And talk about what are some of the main things I need to really force me into a trade. I've said a bunch of times, one of my most popular tweets of all time was, great traders don't force trades, they're forced to trade. And some of our trades, we get in and we get out, not necessarily because we're forced in, but we like the area, we nibble, the market proves something to us, and then maybe we get aggressive or we cover it. But our favorite setup, that forces us in. So for me, that's extremely important for you as a trader coming off a drawdown to go back and lean on your favorite setup. Traders, what did you think about that sequencing I did around the 200-day moving average? Let me know your thoughts by putting your comments down below. Never miss an episode of Develop Your Edge. Click that subscribe button right there. You can also DM me on Twitter. My DMs are open at Anthony Crudelli. Don't forget to check out Instagram. A lot of cool stuff going on there. Anthony C. Crudelli. That's a wrap for today. See you next week.